Your wallet is bleeding every single week. But what if your portfolio paid you every week instead? I built a portfolio of 12 dividend stocks, 6.2% average yield. That's 3 times what the entire stock market pays. A dividend check hits your account every single week of the year. Most dividend investors are doing it completely wrong. They chase the highest yields, REITs, energy stocks, all in. Then one bad quarter wipes out their entire income stream. That's not a dividend portfolio. That's a trap. The real strategy isn't chasing yield, it's engineering timing. Select stocks that go ex-dividend in different weeks each month. Suddenly, every single week becomes payday. The first 3 dates every dividend investor must know cold. The declaration date. The board announces the dividend. The ex-dividend date. The most critical date of all. Miss it by 1 day, you wait another 3 months. The payment date. Money lands in your account, usually 2 weeks later. Know these dates. Own the shares in time. 0 exceptions. Now 12 stocks. Let's break them down one by one. Stock number 1. JP Morgan Chase. 3.15% yield. This bank manages over $3 trillion in assets. $12.2 billion in consumer banking revenue. Single quarter. Dividend has doubled over just 5 years. Analysts see 27% upside from current levels. Stock 2. Global Net Lease. A jaw-dropping 10.5% yield. 309 properties. 3 continents. 99% occupancy. 138 tenants across 51 different industries. You're not just diversified, you're insulated. Stock 3. Gladstone Commercial. 6.6% yield. Monthly payer. 122 properties. 28 states. 96.6% occupancy. Average lease terms of 7.5 years. This is consistency. This monthly payer doubles your income 2 specific weeks every month. Stock 4. Conagra Brands. Consumer staples. 3.5% yield. You've been buying their products your whole life. Recession-proof. Trading at a 10% discount to its 5-year average P/E. Stock 5. New York Community Bank. 6.8% yield. 50 years in the New York multifamily lending market. $87 billion in assets. Over 400 branches. Here's the angle nobody is talking about. Rising rates are good for this bank. $500 million in excess capital after paying the dividend. Trading at just 0.72 times book value, deep value territory. Stock 6. Arbor Realty Trust. 8.25% yield. Direct lender to multifamily, senior housing, healthcare real estate. 83% of loans are agency-backed. Maximum safety profile. Dividend growing 16% annually for 5 straight years. Revenue growing 20% per year. This thing has serious momentum. Stock 7. Southern Company. Utility play. 3.6% yield. 4 million electric customers. 4.4 million natural gas customers. Coal was 80% of their power in 2000. Now it's only 20%. Stock 8. Newell Brands. 4.1% yield. 25 brands you already own. $10 billion in annual sales. Operations across 10 countries. Analysts see 22% upside. Most dividend investors completely overlook this one. Stock 9. Devon Energy. 7.3% yield. Energy powerhouse. Free cash flow quadrupled after merging with WPX. Still profitable even if oil drops to $30 a barrel. The dividend went from 6 cents to over $1. That's 600% growth. Stock 10. Camping World Holdings. 9.6% yield. The bold pick. Controls 20% of the RV market growing 10% every year. Dividend surged from 7 cents to 62 cents, a 756% increase. Over 11 million US households own an RV. This market is enormous. Stock 11 is the controversial one. Altria Group. 6.5% yield. Yes, it's the cigarette company. But before you click away, Hear the real story behind why this cash flow machine belongs in a dividend portfolio. Yes, cigarette volumes are declining year over year. Nobody denies that. But Altria's pricing power has kept cash flows extraordinarily stable, and they've reinvented themselves for what comes next. They dropped $1.8 billion into Kronos Group, a cannabis company, and now own a 45% stake. That's a massive position in an industry that is still in its early innings of becoming fully legal across the United States. They also hold a 10% stake in Anheuser-Busch. Altria isn't just a cigarette company anymore, it's a cash flow engine betting on the vices of the next generation and collecting a 6.5% yield while it waits. And finally, stock 12, Realty Income. They literally call themselves the monthly dividend company, and they've earned that name with 50 years of unbroken operating history. Over 6,000 properties in 49 states plus Puerto Rico and the United Kingdom. This is not a small operation. This is one of the largest REITs in existence, and its portfolio spans an almost incomprehensible range of commercial tenants. 88 consecutive quarterly dividend increases. Count that 88 inches a row. No cuts, no pauses, no excuses. For over 2 decades, shareholders have received a bigger dividend check every single quarter like clockwork. Occupancy has never once dropped below 96% in its entire history. While other REITs scramble to fill vacant properties during recessions, Realty Income kept collecting rent because their tenants are necessity-based businesses that never really close. Its 4.5% annualized dividend growth beats the REIT sector average of 2.9%. That gap matters. Over 20 years, that difference compounds into dramatically more income for shareholders who held on. Goes ex-dividend in the last week of every month, timed perfectly to cover your first of the month bills. Rent, mortgage, utilities. Realty Income is essentially paying your fixed expenses on a monthly schedule. Now let's talk about what this full portfolio looks like on a calendar. 12 stocks, 52 weeks. And if you map out every ex-dividend date, you'll find that at least one stock goes ex-dividend in every single week of the year. That's the engineering. Week 1 coverage. JP Morgan Chase goes ex-dividend in early January. The anchor stock, 3.15% yield and a balance sheet measured in trillions. That's how you start the year with the most stable financial institution in the country putting money in your pocket. The blended portfolio yield lands at 6.16%. Let me put that in real dollars. On a $250,000 portfolio, that's $15,400 per year or $296 per week, hitting your brokerage account automatically with zero additional effort from you. Scale it up to $500,000 and you're collecting $592 per week. On $1 million portfolio, you're generating over $1,100 in dividend income every single week without selling a single share. Here's the reality check most finance influencers won't give you. Even a 10% yield on $100,000 only generates $830 per month. That's $10,000 a year. Dividend investing doesn't replace your income overnight, it builds over decades. I personally have over $500,000 in dividend stocks. I collect nearly $500 per week in payouts. But that's the result of more than 20 years of consistent saving and investing, not a shortcut, not a hack, not luck. The real secret to this portfolio isn't the yield, it's the growth. These 12 stocks weren't selected just for their current payouts. They were selected because they've consistently grown both their share prices and their dividends year over year, creating a dividend snowball. As dividends grow and you reinvest them, you buy more shares. More shares generate more dividends. More dividends buy more shares. The cycle feeds itself. This is how $500 weekly passive income eventually becomes $1,000 weekly without adding a dollar. 12 stocks. One portfolio, a 6.16% blended yield. A dividend check every single week of the year. That's not magic, that's engineering. Map the dates. Diversify the sectors. Layer in the monthly payers. Let time compound the results. Start building today. Stay consistent for decades. Because one day your portfolio will be the ATM machine running automatically whether you are thinking about it or sitting on a beach not thinking about it at all. JP Morgan manages over $3 trillion in assets in its wealth management segment alone. That's not a bank, that's a financial empire that keeps printing money through every market cycle. In a single quarter, JP Morgan's consumer banking division booked $12.2 billion in revenue. That's one division, one quarter, and it's still just a fraction of the total machine. JP Morgan's dividend has doubled over the past 5 years. Analysts see 27% more upside from here. This is the anchor stock your dividend portfolio needs: stable, growing, and deeply profitable. JPM goes ex-dividend in the first week of January, April, July, and October 4 times a year, reliably, giving your portfolio its quarterly anchor payment right at the start of each season. Now let's talk about the highest yielding pick on the list. Global net lease ticker GNL pays a jaw-dropping 10.5% yield. That's more than 3 times what the S&P 500 pays. Global net lease holds over 309 properties spanning 39 million square feet. But here's what makes it different from most REITs. Those properties are spread across the US, Canada, and Europe simultaneously. GNL has 138 tenants spread across 51 industries. If one sector implodes, retail, office, whatever, you're covered. That 99% occupancy rate isn't an accident. It's the result of deliberate diversification. More than half of GNL's entire portfolio sits in industrial and distribution real estate, the segment booming from e-commerce growth. Warehouses, logistics centers, fulfillment hubs, the backbone of modern retail. On top of that 10.5% yield, analysts see 21% price upside for GNL. You're getting paid massively to wait while the stock potentially appreciates. That's the double play dividend investors dream about. Next up is Gladstone Commercial, ticker GOOD, paying 6.6% yield. But the real reason it's on this list has nothing to do with the yield number. It has everything to do with the payment schedule. Gladstone Commercial is a monthly dividend payer. That means instead of waiting 3 months between payments, money lands in your account every single month right around the 3rd week. Gladstone owns 122 properties across 28 states with 96.6% occupancy. Average lease terms run 7.5 years, meaning tenants are locked in long-term, providing visibility on future income that most stocks simply can't match. Here's how the monthly payer changes the math. 2 weeks every month, GOOD's dividend overlaps with another stock's payment window. That means you're doubling up on income during specific weeks without adding any extra capital. Conagra Brands, ticker CAG, brings consumer staples into the mix at a 3.5% yield. We're talking about Slim Jim, Bird's Eye frozen vegetables, Hunt's, healthy choice brands in 100 million American homes right now. Conagra stock got hammered over the past year as inflation squeezed margins. But that's actually the opportunity. Shares now trade at a 10% discount to their 5-year average price-to-earnings ratio. With earnings recovering and analysts targeting prices as high as $40 per share, Conagra fits the dividend playbook perfectly. Buy when temporarily beaten down, collect the yield, and ride the recovery. CAG goes ex-dividend in the 4th week of January, April, August, and October, strategically filling the calendar gaps left by JP Morgan and setting up a tight, consistent weekly payment rhythm. New York Community Bank, ticker NYCB, offers one of the highest dividend yields in the entire banking sector at 6.8%. 50 years in the New York multifamily lending market, this isn't a startup, it's a proven institution. NYCB holds $87 billion in assets and operates over 400 branches. It's not a boutique lender, it's a major regional bank aggressively expanding its footprint while maintaining that high dividend payout. Here's the angle nobody's talking about with NYCB. Rising interest rates are actually good times for banks. Higher rates mean more profit on every loan issued. NYCB is already generating $500 million in excess capital after paying dividends. NYCB trades at just 0.72 times book value. In plain English, you're buying $1 worth of bank assets for 72 cents. That's deep value territory, and the 6.8% yield makes waiting for the market to correct that mispricing very comfortable. Arbor Realty Trust, ticker ABR, pays 8.25% yield and is a direct lender to multifamily housing, senior housing, and healthcare real estate. 3 of the most in-demand real estate categories in America right now. 83% of Arbor's loan portfolio is backed by government agencies. That means if borrowers default, federal guarantees absorb the loss. You're getting an 8.25% yield with government-backed safety nets underneath it. Arbor's dividend has grown at 16% per year for 5 consecutive years. Its revenue grew 20% per year over the same period. When both the dividend and the underlying business are growing double digits, that's a rare find. As residential home prices stay elevated and push more people into renting, demand for multifamily housing only accelerates. Arbor sits directly in the path of that demographic and economic tailwind heading into next year. Southern Company, ticker SO, pays a 3.6% yield and is the utility play that keeps the entire portfolio grounded. Utilities are boring. That's exactly the point. Boring means reliable. Reliable means the dividend never stops. Southern Company serves over 4 million electric customers across Georgia, Alabama, and Mississippi, plus 4.4 million natural gas customers. That's 8.4 million households that literally cannot function without paying their bill. In 2000, 80% of Southern Company's electricity came from coal. Today, that's dropped to just over 20%, replaced by nuclear, natural gas, and renewables. This utility is actively future-proofing itself and the dividend along with it. Esso goes ex-dividend in the third week of February, May, August, and November. Plugging directly into calendar gaps left by the first three stocks every quarter, the weekly payment chain stays unbroken. Newell Brands ticker NWL is grossly overlooked by dividend investors. Most people hear Rubbermaid and tune out. They don't realize NWL also owns Coleman, Yankee Candle, Sharpie, Mr., Coffee, and over 25 brands total. Newell generates over $10 billion in annual sales across operations in 10 countries. That kind of global revenue diversification means no single market downturn can kill the cash flow that funds the 4.1% dividend. Analysts see 22% upside in Newell Brands from current prices. Combined with the 4.1% dividend yield, you're looking at a total potential return profile that most people building dividend portfolios completely miss. NWL goes ex-dividend in the last week of February, May, August, and November, 1 week after Southern Company. Back-to-back weeks of payments in the same months. The calendar engineering is clicking into place. Devon Energy ticker DVN pays a 7.3% yield and operates oil assets in North Dakota, Texas, and Delaware. After its merger with WPX Energy, free cash flow quadrupled. That's not an improvement, that's a transformation. Devon can remain profitable even if oil drops to $30 a barrel. When most energy companies start panicking at $50, Devon is still generating positive free cash flow. That operational efficiency is what protects the dividend in downturns. Devon's dividend grew from 6 cents per share to over $1. That's a 600% increase in just 5 years. Read that number again. 1,600%. This isn't dividend growth, it's dividend explosion. DVN goes ex-dividend in the first week of March, June, September, and December, filling the early month gap in Q1, Q2, Q3, and Q4 perfectly. It pairs beautifully with JP Morgan to anchor the first week of every quarter. Camping World Holdings ticker CWH is the bold pick on this list. 9.6% yield. Volatile price. But the dividend per share has grown from 7 cents in 2017 to 62 cents today. That's a 756% increase. You can't ignore that. Camping World controls 20% of the entire RV market, and that market is growing at 10% per year. Over 11 million US households already own an RV. Retiring baby boomers and younger generations are both driving that growth simultaneously. Analysts see roughly 64% upside in Camping World from current levels. Combined with the 9.6% yield, if even half those analyst targets hit, total returns over the next few years could be extraordinary. Yes, CWH is the highest risk pick on the list. The stock is volatile, but risk and reward are always correlated, and the ex-dividend dates plug cleanly into the calendar. High yield with high upside sized appropriately in the portfolio. Altria Group ticker MO is the controversial pick. Yes, cigarette volumes are declining, but Altria has held onto pricing power so tightly that cash flows have barely budged despite volume drops year after year. Altria owns a $1.8 billion stake in Kronos Group, giving it 45% ownership of a major cannabis company and a 10% stake in Anheuser-Busch InBev. This isn't just a tobacco company. It's a diversified vice conglomerate. Altria pays a 6.5% yield and goes ex-dividend in the third week of March, June, September, and December right alongside Devon Energy, creating a powerful double payment week at the heart of every quarter. For dividend investors who want cash flow without chasing growth, Altria is a machine. Decades of consistent payouts, a habit-forming product base, and 2 embedded bets on future growth industries. The controversy is already priced in. And now the crown jewel of dividend investing. Realty Income ticker O, known officially as the monthly dividend company. This is not a marketing slogan. It is a 5-0-year operating commitment. Realty Income has reported 88 consecutive quarterly dividend increases. Not 88 payments, 88 consecutive times increases *. each quarter higher than the last, for over 2 decades, without a single cut or pause. Realty Income owns over 6,000 properties in 49 states plus Puerto Rico and the United Kingdom. Occupancy has never, not once in 50 years, dipped below 96%. That's not luck. That's institutional quality asset management. Realty Income's annualized dividend growth rate is 4.5%, significantly above the REIT sector average of 2.9%. That gap compounds powerfully over time, turning a 4% yield today into a much higher effective yield on your original investment years from now. Realty Income goes ex-dividend in the last week of every single month 12 times a year, timed perfectly to help cover the bills that land on the first of the month. Rent, mortgage, utilities, your portfolio handles it. Now let's put the full calendar together. 12 stocks, 52 weeks. Here's what the complete payment schedule actually looks like when you map every ex-dividend date across the full year. Q1, JP Morgan covers week 1 of January, Conagra covers week 4, Southern Company hits week 3 of February, Newell week 4. Devon and Altria both land in March. Gladstone and Realty Income fill every remaining week monthly. Q2 mirrors Q1 almost exactly. The quarterly payers repeat their patterns. April brings JPM and CAG, May brings SO and NWL, June brings DVN and MO. Monthly payers continue filling every gap. No week is ever empty. The 2 monthly payers, Gladstone, Commercial, and Realty Income, are the glue of this whole strategy. They pay in weeks where no quarterly payer is scheduled, ensuring literally 0 weeks without a deposit hitting your account. The blended yield across all 12 stocks lands at 6.16%. The S&P 500 yields roughly 1.5% right now. This portfolio generates 4 times the income of the market with stocks that also have price appreciation potential built in. Let's do the actual math. If you invest $100,000 in this portfolio at a 6.16% blended yield, you're generating $6,160 per year, or roughly $513 per month, $118 per week, landing consistently throughout the year. Scale up to $250,000 and you're generating $15,400 a year, or $1,283 per month. At $500,000, that becomes $30,800 annually, nearly $2,600 every month in dividend income without selling a single share. The creator of this portfolio has over $500,000 in dividend stocks and collects nearly $500 per week in payouts. But here's the part people don't want to hear. It took over 20 years of disciplined investing to get there. This is where most people quit. They see the 2-0-year timeline and close the tab. But they're missing the math of compounding because dividend reinvestment doesn't grow linearly. It grows exponentially. When you reinvest dividends, you're buying more shares. More shares generate more dividends. Those dividends buy even more shares. The snowball effect is real and it accelerates dramatically in years 10 through 20. $10,000 invested at 6.16% yield with full dividend reinvestment grows to roughly $33,000 in 20 years without adding a single additional dollar. Add consistent monthly contributions and the number becomes truly life-changing. The biggest mistake dividend investors make isn't picking the wrong stocks. It's chasing yield without considering safety. A 15% yield on a stock that cuts its dividend leaves you with nothing and often a cratered share price on top of it. Every stock on this list was selected because it grows both its dividend and its share price over time. That's the filter. Not the highest yield, the most reliable, growing, total return producing dividend story. Sector diversification matters just as much as ex-dividend timing. This portfolio spans banking, REITs, consumer staples, utilities, consumer goods, energy, and real estate. If one sector gets crushed, the other 6 keep paying. Contrast that with the classic mistake, going all in on REITs for the high yields. When real estate had its bad year in 2022, single-sector REIT portfolios got decimated while diversified portfolios barely felt it. There's a smarter way to think about dividend yield targets. Most financial advisors say 4% is the safe withdrawal rate in retirement. This portfolio's 6.16% yield gives you a 54% cushion above that baseline while keeping your principal intact. That means if you need $4,000 per month to cover your retirement expenses, you only need roughly $780,000 in this portfolio to generate it versus over $1.1 million needed at S&P 500 average yields. And the weekly payment structure isn't just psychologically satisfying, it's financially strategic. Weekly income means you're not waiting 90 days to redeploy capital. Cash is always available for opportunities or bills as they arise. Let's revisit the 3 key dates one more time because missing even one of them wipes out a quarter of income. Declaration date, ex-dividend date, payment date. Burn these into memory before you buy a single share. Miss the ex-dividend date by even a single day and you don't get paid. Not a smaller check, nothing. You then wait another 3-4 months. 1 day's delay costs you an entire quarter of income. This is not a drill. The payment date typically lands 2 to 4 weeks after the X date. So if you own the shares by the X date, set your calendar and expect the deposit within about a month. Automate, track, don't guess. One of the most powerful features of this portfolio isn't the yield, it's psychological. When you see a weekly deposit in your brokerage account, it reinforces the habit. You stop watching price charts. You focus on income. That mental shift is priceless. Most retail investors check their portfolio value daily and panic on red days. Dividend investors check their income calendar. 2 completely different games, and only one of them actually builds wealth without destroying your sleep. Building this portfolio doesn't require $500,000 upfront. Start with 1 or 2 of these names, reinvest every dividend, add contributions monthly, and let time do what time does. The weekly paycheck will come just later rather than sooner. Think about where you want to be in 10 years. With disciplined dividend reinvestment and consistent monthly contributions, even a modest starting point of $25,000 can compound into a real income-generating machine by that time frame. Dividend investing is one of the few strategies where time in the market is genuinely more important than timing the market. Every week you're not invested is a week of income you can never get back, permanently lost to an action. Here's the full list one more time. JP Morgan, Global Net Lease, Gladstone Commercial, Conagra,